Ladies and gentlemen, welcome back to the channel. We have big data and events coming up for markets, which are going to be critical for your portfolios. Now, here on the day today, markets did not exactly perform very well. It was a rough day for markets. Stocks look like they want to fall further. Now, with tomorrow's economic data and the significance of this, it looks like it was leaked again to big money. What was leaked to big money? In my opinion, I will share that with you in this video. Now, number one, first and foremost, it's important to remember that at the same time, Wall Street, as of lately, has been telling you, go long this market. Don't be scared of this market. Don't sit out this market. Now is not a time where stocks are going to fall. In reality, you have a little bit different of a scenario. You're actually seeing big money hedging their portfolios. Big money is scared of the downside. They think that there can be quite a bit of downside from current levels. And we really see this reflective in, well, the VIX. The VIX today surged 7% heading into tomorrow. So what does this mean? This means that there's more calls being bought, or more puts being bought on the S&P than calls. It means that there is less call premium right now, and there's more put premium. So premiums are going higher, and more people are buying puts than calls, especially today with a 7% spike on the VIX. Now, let me just say this. The data you got today actually wasn't terrible for markets. You had ISM data for ISM services that came in. Besides employment, everything else came in good. Markets actually rallied upon this ISM data. What caused markets to sell off, at least initially, before then bouncing back and going green again, was speculation that Israel may attack Iran's oil facilities. And this could spark oil to rally aggressively. Some people are saying over $200 a barrel. Some people are saying over $100 a barrel. Either way, this creates a big problem for markets, okay? This creates a big problem for the economy. Now, whether or not someone knows when there is going to be that strike is one thing, okay? From my perspective, over the past couple of weeks and months, it has become unequivocally obvious with that rumor of NVIDIA being served a subpoena causing NVIDIA to fall 9%. Keep in mind, we did not know that in what was going on with NVIDIA. There was no news that hit the headlines. NVIDIA was down 9%. 10 minutes after markets closed that same day, the news about the subpoena came out, okay? Things like that have really caught my attention in the last couple of weeks, and it looks more obvious, it seems like every week, that there is a systemic risk right now within markets. The risk is that a large financial institution is caught offsides, okay? People want to be bullish, but when there's major events that disrupt that, like a potentially bad jobs report coming tomorrow, maybe an Israel strike on the oil facilities in Iran, then that threatens financial stability. That could potentially put a large financial institution in a bad position. We already know that some of them are struggling as is. So that's not exactly the situation the government wants to put those firms into, because, I mean, think about this logically. We are one major banking crisis, one existential crisis away from a recession. So it seems like from that standpoint, even if you're going to get bad news, you want to warn the most important players of that first, okay? That's why I think you're getting some of this leaked activity that has been happening lately. Now, again, back to the VIX. I mean, this is basically snitching and saying you're about to get a major volatility catalyst. You're about to get some bad news. Now, who knows exactly what this is? It could be the jobs report coming out tomorrow. It could be the Israel situation. I'm not exactly sure. But within the next day, tomorrow, in other words, you are going to get a large move in markets, up or down, for better or for worse. Right now, it looks like for worse would be the bet that would make the most sense, especially if non-farm payrolls come in disappointing. And really, the ISM services employment data, ISM manufacturing data, ADP employment change, Challenger job cuts, all of the recent employment data we have gotten has been bad, okay? I don't know why the non-farm payrolls would be any different. I think expectations of 140,000 jobs are pretty high. Same is true for the unemployment rate, not expecting that to move up at all. They're pretty high expectations. Like, there's a good chance that we do move higher on the unemployment rate. There's a good chance jobs report comes in lower than 140,000 jobs tomorrow, and that becomes a major problem. I think that's why you got this selling activity in markets today, because again, if you're leaking the news, the info to big money's going to go out and buy puts. They're going to go out and hedge portfolios. They're going to do what they have to do to minimize risk. But it's not going to move the markets that much. Like, it's going to move the markets enough to, move markets down 0.5% or so, like you're seeing today, but not enough to cause a 2 or 3% down move, right? So that is pretty telling from my opinion. And even when you look at the technicals on the S&P, I mean, it looks like markets want to break down lower. Typically, you start this curling action, it kind of starts slow, and then the volatility really picks up, and then you start to kind of gap down afterwards. Like you even seen in April of 2024, April of this year, you kind of crept down lower, a lot of volatility back and forth, and then you really start to get the selling. And in just a couple of, bad red days, you fall substantially. Now take a listen to this recent clip that I shared with you in the last video, but I think is critically important that we all understand.
So right now you're looking at S&P futures. You say they broke through a key support level. Spell it out for us. Walk us through the chart. We made it. What are you seeing in the chart? What's that key support level, and what does it say to you?
Yeah, I think when you're looking at the S&P futures, that's a December futures contract, and it broke down below 57.80. And that break below there was sort of this pattern where, we had such a huge run up from August. We had a little bit of a volatility event occur, that yen again, get 'em kind of action where people unwound the yen carry trade. And then the market rose and has kind of been topping out here. It broke below that 57.80 level. And so that's one area I'm looking for. We really haven't been able to get back above it. And as you see the futures trading lower, as you mentioned earlier today, this morning, that's a little bit of an indication that we just really can't get above there. So I'm a little bit cautious until we get above that 57.80 level.
So just to be clear, that's in your mind a bearish signal.
It is. And this kind of little pattern is almost a mini head and shoulders top. It's not like a wide range that a lot of technical traders look at. But when we're looking at a 5-minute chart and what's going to happen short term, and this little increase in volatility here to start October, to me, it's a little bit of a bearish move here. And that 57.80 level was really a critical level that we broke below. And so I think now the pressure is a little bit to the downside in the near term right now.
What about the pricing when it comes to downside protection? Has that significantly increased? I mean, we have had a lot of big macro events just in the last recent days.
Yeah, we have. And you laid out the weeks ahead here and all the events that we have going on, geopolitical and whatnot. And we have started to see put traders in the S&P 500 start to uptick the premiums that they're willing to pay relative to calls on the upside, right? So a put is a protection to the downside on the market. And we've seen a heightened level here over the last, let's call it month or so, where basically traders are trying to buy more protection to the downside than they really want to the upside. That trend completely reversed. Really, for the last 2.5 years, it's been the other way around, where we continually saw call buyers come into the market, any kind of dip in the market. Traders were in there trying to buy the upside call. The reverse has really happened over the last 2 months, and that's a little bit concerning that institutional traders are out there wanting this protection for the downside. But look, obviously, a lot of geopolitical tensions out there in the atmosphere, an election coming next month, couple that with another Fed meeting at the beginning of November, 2 unemployment reports really in the next month, if you consider this Friday and the week of the election week. So
Well,
And then
Brian,
couple that with earnings, a lot of volatility to be
I don't want to
expected.
interrupt you, but you're spelling out, I think, the next question I want to ask you. What's the options market telling us about these upcoming events? You mentioned it just about a month away. The election's coming up. We have big jobs reports. We have a Fed meeting. I mean, what is the options market telling us about all that?
Well, when we look at the level of volatility where the VIX is at, I'd expect over 1% moves in the market back and forth on a daily basis. Now, we saw that a little bit to start October. We haven't really seen that the last couple trading days. It's kind of hung in there. I think it's waiting to digest the unemployment report coming out this Friday here, and then maybe make a move here. But certainly expectations are heightened that we're going to get a fairly sizable volatility event or move here coming up in October.
All right, what about the NASDAQ futures? I thought there were some interesting moves there. Kind of spell that out for us as well.
Yeah, the NASDAQ is sort of interesting, right? Because when sort of the yen carry trade unwound a bit in August, we obviously saw a lot of selling pressure in the NASDAQ. Sort of it seemed like people were moving out of risky assets, heading into that 10-year note, the U.S. Treasury market, and the NASDAQ had some selling periods. And then all of a sudden it rebounded right back, really here, that 17,000, 18,000 level, I should say. And now it's kind of also stalling out a little bit. So that's something I'd be a little worried about, that we get this carpet shakeout back to the downside, some sort of retracement back towards those lows that we saw back in August. Maybe not all the way down, but something where the market's looking for a little bit of a pullback.
So with that said, let me know what you think about this information down below in the comment section. What do you think was leaked? Do you think anything was leaked? Does this not make sense to you at all if you've been a viewer of this channel for a while? Hopefully you've kind of noticed some of these trends and patterns that are happening right now. It seems like the government, the Fed, whoever it is trying to protect the large institutionally important institutions. These are not your average hedge funds. These are market makers. These are big investors, right? This is like a Citadel, right? That runs a market maker, also runs a hedge fund. This is Virtue. This is Sequoia potentially. This is State Street or Vanguard. These are the kind of guys that are being tipped off on this information. And I don't really think it's necessarily just economic data or just the Fed, policy changes, which is more so what we've seen recently. But I also think it can be, Israel attacking back to Iran, right? A retaliation attack, because that can be very disruptive to markets as well. And that is one of those other, catalyst that could, shake things up quite a bit, and especially in the oil market. The last thing you want, Citadel or a State Street or Vanguard with a massive, short position on oil, and next thing you know, you wake up and oil's up 20% or something just outrageous. That would be insanely problematic. And that's what I think they're trying to avoid by giving the heads up to these firms that, hey, this is about to happen or that's about to happen. And that's what I think is occurring as of the last couple of months, as the economy is really on this borderline between we can't absorb another big negative shock or we'll go into a recession. So let me know what you think about this. Again, down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.